What's happening right now. Sajjid Chinoy is with us at JPMorgan. Samiran Chakraborty is with us at Citi. Gentlemen, good morning. Great to have both of you here. Thank you very much for joining us. We, the equity folk, get very excited, and we need, economists to bring us and keep us on an even keel, if I can say so. So thank you very much once again. It's a Sunday morning, and it's good to see both of you. Sajjid, let me start with you. I read that report, and I think it's a brilliant way you capture the essence of what to expect, right? 5 questions. And there is so much in there. But, one or two things which is really top of mind as you get ready to hear the finance minister lay out the budget speech.
So, Prashant, I think first and foremost, I can't think of a time in recent years when there's been such a hostile and uncertain global backdrop. Remember, in the COVID year, the budget happened in February, COVID kicked it in March. The next budget was a year later, by which time we had some sense of how COVID was playing out. This is truly uncharted territory where, the system that we've known for the last 80 years globally is unraveling. That creates both near-term uncertainty and creates concerns about medium-term growth. So I think the challenge before this budget is twofold. That on the one hand, when you've got all this global uncertainty in financial markets, the typical tendency of emerging markets is hunker down, right? Create buffers, create fiscal buffers, create monetary buffers, create external buffers. But, that sometimes comes at the cost of growth. Whereas the other impulse is going to be in such a, environment where, economic heft determines geopolitical heft. The tendency and the temptation will be to be adventurous and to be expansive. And so that, for me, is the central challenge between this budget. How do you simultaneously be conservative and be adventurous? My sense is that the way this will happen is the fiscal math will be conservative. I think, as was just said, a lot of the fiscal action happened last year. Direct tax cuts, GST cuts, with nominal GDP growth expected to be in single digits. There isn't much fiscal space, so I'd expect there'll be fiscal conservatism, which has been the hallmark of this government, to under-promise and over-deliver. I think we'll meet this year's target of 4.4, and there'll be more consolidation next year. So the numbers, I think, will be quite conservative. What everyone is hoping for is, outside the fiscal math, can we get announcements that excite not investment, and hopefully attract back capital flows. But it's that mix of conservatism and adventurism, I think, that will be key in today's budget.
Okay. Hi, Sajjid and Samiran. Thank you very much for sparing time for us. Samiran, you've read the survey with a fine-tooth comb. Can you help us with what sectors or ideas may get prominence?
So thanks, Lata. I guess there are two broad questions in front of the budget today. One is about allocation of capital, both domestic and foreign. At this point of time, we have less of foreign capital into the country and more of domestic savings coming in. But within domestic savings, there is a preponderance towards equity rather than debt. How do we manage this through effective policy instruments in the short run is one of the challenges that I will be looking out for in the budget. And the second one, as Sajjid was mentioning, that in an absolutely hostile global environment, we need to rethink about our broader growth strategies. The survey is indicating that we should push towards manufacturing, not only domestic side, but also manufacturing for exports. We have heard this before, but this time around, what kind of newer strategies the budget throws up to achieve that goal? I think that's also will be very important for me. So both the financial side of the economy through better allocation of capital and the real side of the economy by pushing for manufacturing in a bigger way. I think these two would be top of my mind.
Okay, let me persist with that fiscal math, which Sajjid took us through, Samiran. We now have the new how the new CPI series might look. And it looks like the CPI is going to be about 20, 30 basis points. Sonal Verma is saying even 50 basis points higher. Plus, the real GDP is forecast by the survey at 6.8 to 7.2. So do you think that the budget would be well within its rights to work with a nominal GDP as high as 400 trillion? Would the bond markets be upset that the calculation is too aggressive if they did that?
I think about a 10% plus nominal GDP growth in the budget, 10 to 10.5, I think will be treated by market as quite reasonable. But on a slightly different note, I think the challenge in this whole new CPI series is that the more the FY26 numbers are higher in the new series, there's a chance that the FY27 numbers will be lower by an equivalent amount, because the base effect will work in the reverse direction then. So what we have written is that while we understand that 40 to 50 basis point is FY26 numbers possibly higher, but at the same time, everything else equal, there's a 25 to 30 basis point downside risk to our FY27 CPI just because of this reallocation of weights.
Okay, fair point. Sajjid, what's your sense about any sectoral push, any read-through from the survey?
So a couple of things, Lata, just to finish the discussion on the fiscal math. I think it's important to appreciate that we first have to hit this year's deficit. I have no doubt we will. But just to let you know, gross tax growth, even though December was very strong, April to December is running at about 8.5%.
Lower.
And so you need an asking rate of above 20% in Jan, Feb, March to hit your budget target. There's a sense here that gross taxes could be as high as 0.4% of GDP lower than was budgeted. The good news is that there were always buffers built on the expenditure side. And you've got buffers on non-tax revenues because both PSU and RBI dividends have been very high this year. So my sense is you'll get a rebalancing in the RE number in terms of taxes and non-taxes. Lower gross taxes and lower net taxes, higher non-taxes. Similarly, in the expenditure side, don't be surprised if CapEx actually beats last year's target, but revenue expenditure is much lower. So the first point is just to understand how this year's math plans out. No, I think on going forward, the survey makes a very fervent, passionate argument that India has to prepare for a new world. And in a new world, that's what I began. Geopolitical heft comes from economic heft. Somebody once said very famously many years ago, the best foreign policy India can have is to grow at 10% for a decade, right? And so I think the survey lays out some of the guidelines. I agree with Samiran that exports have to be the centerpiece of any such strategy in a world of global value chains. And therefore, what I'm looking for is you had a series of reforms the last 6 months. What will be very important to complement it with it is on the import side. The oldest adage in economics is an import tariff is the same as an export tax or as an equivalent import tax. So this will be a wonderful opportunity to clean up the whole customs duty regime, right? Simplify it, clean it up, rationalize the rates, correct duty structures. That seems to be a natural complement to the series of FTAs that we've signed. And I think the survey did talk about how protectionism upstream creates pressures downstream.
Yeah, just one quick point, Sajjid. The RBI dividend number, it was 2.7 odd lakh crores last year, right? What could that be meaningfully higher? I mean, at the end of the day, gold, dollar are assets, right? Rupee is a liability. Rupee is depreciated. So could that be, could it be really chunky, bigger?
So I think this year the sense is, the dividend is going to be about 30,000 crores higher, but you're exactly right? The revaluation gains will be higher, next year if the rupee continues to depreciate. So that's one, source that has been reliable over the last few years, and that takes a little bit pressure off tax revenues next year. But again, I want the government to be conservative. I think nominal GDP of 10%, would be par for the course. Anything above could be ambitious. We're in a world with lots of Chinese excess capacity. Yes, you get some technical readjustments from the CPI rebasement, but the fact is goods prices are going to be under pressure for the foreseeable future, given what's happening out of China.
Okay, all right, got that, Sajjid. Samiran, let me get you into the discussion then. The rupee weakness is something that has spooked the street, the equity markets as well. Some believe that maybe it's getting stretched on the downside. What do you think?
And what do you expect?
So it's rupees of...
No, what do you expect from the budget?
So rupees of function of balance of payment. So what I was mentioning initially was that one of the challenges for us today is that we are not getting as much of capital inflows that we used to get earlier.
Yes.
We are a lot focused on the FPI number, but the big swing factor has been the FDI number. So in a sense, if we can push for manufacturing in a more clearer way through deregulation and all, then there's a chance that the FDI numbers can also increase. If there is more tax certainty, that could be another factor driving that FDI. But somehow to push the FDI thing will, in my view, in the budget, the best support for the rupee currently. The current account is doing just fine. So it's all will boil down to how we manage the capital flow side. I'm not really very keen to look for more sources of FPI increase through different kind of tax concessions, etc. That's a very short-term approach to getting capital flows. The real big one is to get the FDI numbers much higher.
Fair point. Sajjid, you have written an excellent edit on how the states also have to contribute if we have to come down in terms of debt to GDP. The centre can move the needle only that much. The states have to move much more. It's possible, therefore, that all programs, like we saw in the MNREGS case, will come with more responsibilities for the state. How does it impact CapEx? Is there anything for the markets or for the economy from that kind of a move, which I very strongly expect, more conditions on the state?
Yes. Yeah, my worry, Lata, is that we've had the surge of cash transfers that's proliferated across states. It's now become very fashionable to do so. And as the economic survey also pointed out, these things come at a cost. And the cost has been twofold. One is you're seeing upward pressure on state deficits. We now have the RBI report on state finances. Last year was 3.3% of the deficit, which is not small. It's been widening in recent years. And there is a risk it's even higher this year. Remember, when there's a shortfall of gross taxes at the center of 0.4% of GDP, a lot of that is then shared by the states. So there'll be a shortfall of taxes for states as well, right? Number one. And number two, the other hit has been that we've just begun to see signs the last 6 months that all the spending on cash transfers affecting capital expenditure by the state. So what the center may propose, the states may dispose. So I think the real story in the coming months is going to be state finances, not central finances. And I'll say one quick thing also. Small changes in nominal GDP growth have huge implications for the asking rate for fiscal in the next 5 years. If the nominal GDP growth is 10%, the center can take its deficit from 4.4 to 3.6, most of which will happen by interest to GDP going down and meet its 50% of GDP debt target. If nominal GDP goes to 9%, is running at 9% for the next 5 years, which is not implausible, then the center's deficit has to go all the way from 4.4 to 3%. And in that environment, if states don't consolidate, debt on a combined basis doesn't move at all.
Sajjid and Samiran, thank you very much for joining us. It's a big day. It's one of those days where, I think the markets interface with macros directly, and the big numbers make all the difference. We'll speak to you as soon as the budget speech, of course, ends for your first reactions out there. Let me toss it back to Shireen in Delhi. She's got another star-studded panel. Shireen, over to you.
Sajjid, I've got a power-packed lineup here at the CII, and everyone's calling you Professor Chinoy. So thank you, Sajjid, for doing a stellar job of putting together the micros and the macros for us here on CNBC TV 18. You're getting a tip of the hat here from the folks at CII who've been listening in to your conversation. But let me bring it back here to my conversation with the